Hello students, this is Dr. Chetna Kumawat. Today we are going to start a new chapter which is cash flow analysis. In this chapter we will understand the meaning of cash flow analysis, classification of cash flows, treatment of some special items, format of cash flow statement, preparing cash flow statement, objectives and uses of cash flow statement, some graded illustrations and key terms. In our last chapter, while discussing funds flow statement, we have observed that in a narrow sense, funds means only cash. It is shown in the balance sheet in the form of cash in hand, cash at bank, etc. at a given date, but it does not disclose how the cash was obtained and how the same was used in the given accounting period. The profit and loss account or income statement is also of no help in this regard. For this purpose, a new statement called cash flow statement is required. A statement of cash flow reveals the movement of cash of a business enterprise for the given accounting period, indicating specifically how the cash was generated, that is, when the cash has come from, and how the cash was used, that is, what has been done with cash during the given accounting period. Thus, cash flow statement is a statement of inflows and outflows of cash and cash equivalents in an enterprise during a specific period of time. Such a statement discloses the net effect of operating, investing, and financing activities of an enterprise during a period on cash and cash equivalent and takes into account receipts and disbursement of cash. With this view, a cash flow statement summarizes the causes of changes in cash position of a business enterprise between dates of two balance sheets. According to AS3, an enterprise should prepare a cash flow statement and should present it for each period for which financial statements are prepared. The cash equivalents and cash flows are used in this statement with the following meaning. Cash means not only cash in hand, but it also comprises demand deposits with banks. Cash equivalents are short-term, highly liquid investments that are A. readily convertible into known amount of cash, and B. so near their maturity that they present insignificant risk of changes in value and interest rates. Generally, only investments with original maturities of 3 months or less from the date of acquisition qualify as cash equivalents. Example of cash equivalents are treasury bills, commercial papers, deposit certificates, and money market funds purchased with cash. Investment in shares are excluded from cash equivalents unless they are in substance in cash equivalents. Cash flows are inflows and outflows of cash and cash equivalents. Flow of cash is said to have taken place when any transaction makes changes in the amount of cash and cash equivalents available before happening of the transaction. If the effect of transaction results in the increase of cash and its equivalents, it is called an inflow source, and if it results in the decrease of total cash, it is known as outflow or use of cash. Cash flow excludes movements between items that constitute cash or cash equivalents because these components are part of the cash management of an enterprise rather than part of its operating, investing, and financing activities. Cash management includes the investment of excess cash and cash equivalence. Classification of cash flows. As explained earlier, cash flow statement indicates the cash inflows and cash outflows of cash during an accounting period. Hence, it is essential to know about the various items of sources of cash or inflows of cash and uses of cash or outflow of cash. As per Accounting Standard 3, the changes resulting in cash inflows and cash outflows arises on account of three types of activities, that is, number 1, operating, number 2, investing, and number 3, financing, as discussed further. Cash flows from operating activities. Operating activities are the principal revenue producing activities of the enterprise and other activities that are not investing and financing activities. Hence, these are the results of those transactions and events that determines the net profit or loss. Examples of cash inflows from operating activities are cash receipts from the sale of goods and the rendering of services, cash receipts from royalties, fees, commissions and other revenue, cash payments to suppliers of goods and services, cash payments to and on behalf of employees, cash receipts and cash payments of an insurance enterprise for premiums and claims, annuities and other policy benefits, cash payments or refunds of income taxes unless they can be specifically identified with financing and investing activities, and cash receipts and payments relating to future contracts, forward contracts, option contracts and swap contracts when the contracts are held for dealing or trading purposes. Some transactions, such as the sale of an item or fixed asset, may result in a gain or loss which is included in the determination of net profit or loss. However, the cash inflows relating to such transactions are cash flows from investing activities. Cash advances and loans made by financial enterprises are usually classified as operating activities because they relate to the main revenue producing activities of that enterprise. Now let's understand cash flows from investing activities. Investing activities include the acquisition and disposal of long-term assets and other investments not included in cash equivalents. The separate disclosure of cash flows arising from investing activities is important. Examples of cash flows arising from investing activities are as follows: cash payments to acquire fixed assets, including intangibles. These payments include those relating to capitalized research and development cost and self-constructed fixed assets. Cash receipts from disposal of fixed assets, including intangibles. Cash payments to acquire shares, warrants or debt instruments of other enterprises, and interest in joint venture other than payments for those instruments considered to be cash equivalents and those held for dealing or trading purposes. Cash receipts from disposal of shares, warrants or debt instruments of other enterprises, and interest in joint venture other than receipts from those instruments considered to be cash equivalents and those held for dealing or trading purposes. Cash advances and loans made to third parties other than advances and loans made by a financial enterprise. Cash receipts from the payment of advances and loans made to third parties. Cash payments for future contracts, forward contracts, option contracts, and swap contracts, except when the contracts are held for dealing or trading purposes, or the payments are classified as financing activities. And cash receipts for future contracts, forward contracts, option contracts, and swap contracts, except when the contracts are held for dealing or trading purposes or the receipts are classified as financing activities. Cash flows from financing activities. The separate disclosure of cash flows arising from financing activities is important because it is useful in predicting claims of future cash flows by providers of funds, both capital and loan, to the enterprise. Financing activities are activities that results in changes in the size and composition of the owner's capital, including preference share capital in the case of a company and borrowings of the enterprise. Example of cash flows arising from financing activities are cash proceeds from issuing shares or other similar instruments, cash proceeds from issuing debentures, loans, notes, bonds, and other short or long-term borrowings, and cash repayments of amounts borrowed such as redemption of debentures, bonds, preference shares. The sum of cash flows within an activity, operating, investing, and financing, can be positive or negative. Negative figure is shown within brackets. Sometimes a single transaction may include cash flows that are classified differently. For example, when the installment paid in respect of a fixed asset purchased on installment payment system includes both interest and loan. In this case, the interest element is classified under financing activities and the loan element is classified under investing activities. So this is it for today's lecture. Thank you for patience listening.